coordinates. Okay, today we're gonna start with our lecture, and it starts with the capital budgeting. This slide is available. So, capital budgeting process is actually is the aspect of all different fields, different types of companies. Like all the companies, they have budgeting. They have a budget for something. They need to allocate. And when we talk about the capital budgeting process, is the process that identifies and evaluates different types of long-term capital projects. When it's said in here capital project, it means here that it's a long-term project. Like it's not like 2-3 months project and that's it. So basically the capital budget is allocation of the funds for long-term projects. So in finance, we have capital and we have capital market, we have money market. Money market are the most liquid one because the maturity of the financial instruments are less than 1 year. But when it comes to capital market are the financial instruments where they're traded in capital market, they have got the maturity more than 1 year, like up to 20 years, 30 years, and so on. So this is the main difference that you can capture the keywords like capital and the money. So the capital budgeting process is the process of identifying and evaluating the capital project. So there is the projects where the cash flow to the firm will be received over the period longer than a year. So when you evaluate a specific project, you expect that the project will generate some money to you that will bring you a profit. So that's why you try to identify and evaluate that project. In this course, we'll teach you how to evaluate and how to identify a really best fitted project so that the company can really benefit from it. This is the course is all about. I mean, this first chapter is covered the whole course. However, we will go each chapter with a separate calculation, with a separate detail of it. So capital budgeting process is the process of identifying and evaluating the capital project. So capital budgeting is mainly the allocation of the funds to the long-lived capital project. So the principles and the tools of the capital budgeting are applied in many different aspects of the businesses. Entities, decision-making, and the security evaluation and the portfolio management. So no matter which type of business you're running, you have to know how to evaluate your projects. Even if you work in a construction, you have to know how to do project evaluation, because when you dedicate money for a certain project, when you want to construct a certain building, that building should give you a money. So as a construction company, you have a building, okay? That building consists of 10 flats. So you need to construct it. In order to construct it, there is a cost for it. How much money you will pay to construct it. First of all, the cost consists of the raw materials that you are using it. Okay, where from you're gonna bring these raw materials? Where do you get this logistic transportation issue for your raw materials? How do you finance? Okay, once you have identified the raw materials, the other part is the bureaucratic process, like from the governmental side to get the approval. And it's not easy. Okay, I want to build a building with the 10 flats. I will build it. It doesn't work like this. You have to get a certain approval from the government, certain approval from the architecture department of the government, because the architecture department should approve it. So there's a certain bureaucratic process that gives you a cost that should be included in evaluation of the project. So cost against the profit. So your main job to identify profit, we have cost, we have profit. You're as a financial manager, the main job is to find out a certain project that will bring more profit than the cost in any types of business, in any type of project. So the goal or the job of the financial managers, same in every types of businesses. One more time, guys. If something is not clear, please do not hesitate. Stop me and I will review it again. I will repeat. There is no problem for it. I can review like many times until you get it, the point itself. So the categories of the capital budgeting projects are here. We have replacement projects, we have expansion projects, we have new product and service or new market, we have mandatory projects, and there are other projects. So we will go with each example of the project, like when we need to evaluate the project, in what cases, like when there is a replacement cost, when there is a replacement project, like you have a certain project, you're producing, let's say, certain types of products with the old machinery, but you have decided this year to replace it, the old machinery with the new machinery. So why do you think we will need it to replace any certain machinery? Let's say we used to produce bread and we decided this year to replace it. Why do you think that we might think to replace it? What could be the benefit of replacing it? What could motivate you to replace it? Is there any ideas? To increase?
Productivity.
Productivity. Very nice. Productivity. To increase the productivity. What else?
Effectiveness.
Actually, I can include this productivity, this effectiveness into the productivity. So if you just clarify more specifically the productivity, you want to be more effective. So put yourself to the shoes of the investor who is running a certain project. What is the main job of so what you want to do? First thing, you're an entrepreneur. You want to do a certain project. What is the first thing that you are concerned with?
Increasing profits.
Profitability.
Profitability.
Profit and
Cost.
Elimination of costs.
Reduction of the cost. You cannot eliminate the cost, but at least you can reduce it to its minimum level.
Okay.
Okay, that's actually what you meant. I understand. That's by elimination of the cost. This is what you meant. So our job is, as if you put ourselves into the shoes of the investor or the entrepreneur, is to reduce the cost and increase the profit. This is what we think only. Otherwise, there is no other motives to go and run certain project. Would you run a certain project, I don't know, for free, just giving your time, let's say 1 year and receiving nothing? No way, no way. You are here in the university with some purpose. You're here to get a degree, at the end with this degree to get employed with a successful job, with a higher, really huge, with a high salary. This is your expectation. Something is motivating you. Same thing in the project. When you replace the projects, a replacement project means like you are replacing some certain assets, old with the new, and you're doing it for productivity. You want to be more productive, like less input, more output. You want to be more efficient in terms of cost and more beneficial in terms of profit. This is what we mean by replacement by cost. This is why we are motivated to replace certain assets. Sorry. Expansion projects. You're running certain projects, and you have decided to expand it. You saw that your business that you have established is doing well. You're really making a good money. Then you say, why I shouldn't go further? Why I shouldn't expand it? Because there is a huge demand and my supply should meet that demand. So I should expand the project. So you're making bigger. So you had some certain project, you just add in. Maybe you're open in another branch. Let's say in Almaty, you established educational agency that offers services like providing education abroad. You're finding students from here and sending them abroad to get some education abroad, like for master and PhD level in terms of scholarship and so on in Almaty. And you realize the demand is coming from Atarau as well, like students are interested in Atarau as well. So you decided to open one educational center in Atarau as well. This is what we call expansion. But does it worth to open there or not? This expansion, this incremental part, this is what you're gonna do the evaluation and say, yes, this is feasible project to expand it, then we can run it. Or when we come to the new products and services or new market, like something, a new penetration of the new product into the market, that will motivate you to make a separate evaluation whether you should get this product into the market or not. For example, you were running one business, one line of the business, one line of the product, and you suddenly just came into your mind, why shouldn't I use another product line to penetrate it? But of course, it will cost you to bring it. It will cost you to make it, things to happen. You need to do this evaluation. You need to weigh all the costs and the profits, whether it's beneficial or not. How you are doing it, you will see it. I'm sure that you have seen it before in all finance courses that you have already taken. That give you some notation, that should give you some ideas. NPV. Have you heard about the NPV?
Yes.
I'm sure. Okay, then we're gonna touch this NPV issue in very detail a little bit later. And there are some mandatory projects, that the project that really have to be, the project that have to be employed. So there is no way, even if it's costly, that you have to employ it. And there are some other projects. So then these are the main three projects that we're gonna go through actually. So this, sorry. So basic decisions that are based. So decisions that are based on the cash flows are not the accounting income. So there are some relevant cash flows to consider as a part of the capital budgeting process are called incremental cash flows. It is referring to changes in cash flows that will occur if the project is undertaken, where it's just an assumption. What we like, we are expanding our project. Let's say we are receiving $100 now from certain project, $100,000, $100 million from certain project. And if we want to expand that business, if you want to expand that project, so the incremental value that you're going to receive, extra cash that you're going to receive from the whole project, including both, we call it as changes, incremental value. So incremental cash flow is the difference, the company's cash flow with and without project. Changes that occurs in cash flows that will occur if the project is undertaken and should be considered as a part of capital budgeting process. So there's a terminology which is called sunk cost. It is the type of the cost that has already occurred, but it cannot be recovered. And it cannot be part of incremental cash flow of the capital budget analysis. Like you invested, you spent this money already. That's it. It's sunk. You should accept it. Externality is this as an impact that investment project has something else, whether they're inside or outside of the company, something that externally is affecting your project. And there's terminology which is called as well cannibalization, is a kind of example of externality in which the investment reduces the cash flow elsewhere the company. So take the sales from an existing company project, like immediate buying and selling a certain company, venture issues. So the principle of the capital budgeting, first is the cash flows that are based on the opportunity cost, which is very important. And this terminology that you have seen it in economic courses in microeconomics. The second one is timing of the cash flow is very important as well. The third principle is the cash flow are analyzed on an after-tax basis. The choice of the depreciation method is really playing a significant role as well when you construct the capital budgeting. Financing costs are ignored in here for the cash flow. Financing costs enter into decision-making through the required rate of return. So we are assuming that the rate doesn't change. So when we come to this, by calculation, you will understand better these terminologies. Why they're like basic principles of the capital budgeting. So investment decision criteria that has been used to say, yes, I will accept this project. I will go further with this certain project. Everybody is familiar with this, like using the NPV, the net present value, IRR, payback period, discount payback period, average account return, and the PI. So these are the investment criteria that has been popular and that has been worldwide used. And these are the last resort when it comes to the decision whether you should expand, whether you should penetrate new product, whether we should replace our cost or not. So this is what we do it actually by using this investment criteria. We're gonna review this all, but we're going to solve these questions using this investment criteria by the help of the Excel spreadsheet. And you are welcome to use the financial calculator if you feel that you're really confident to use the financial calculator. As at the beginning, I told you that using the Excel spreadsheet is much more faster and efficient to come up with a certain calculation. So net present value is the present value of all incremental cash flows that are discounted to the present value and minus the investment cost that you incur at the beginning of the year. This is the formulation that you're knowing. So cash flow is actually we mean here, but after tax payment cash flow. So when we deduct all the taxes, we deduct all the depreciation costs. So we are adding back the depreciation in here, then we derive the cash flow. This is what the cash flow we mean here. Required rate of return for the investment. Investment cash flow at a time 0 that you made it after when you decided to go with certain project. And decision to proceed with a certain project or with a positive decision, the NPV should be greater than 0, which means that your net benefit is more than your cost that you incurred. So we are given some information here as an example. They consider that the Hofstad project, which requires an investment 1 billion initially, where subsequent, so we put 1 billion in the first year, in the current, like in year 0, with a subsequent cash flow that will generate like 200 million, 300 million, and 400 million, and 500 million dollars. Like in the first, 2, 3rd, and 4th year, it will generate 200, 300, and 400, 500 millions of dollars. So we can characterize the project with the following year of cash flow. So what is the net present value of that project if required rate of return of this project is 5%? I want to illustrate this example on Excel spreadsheet so that we can understand and it kind of be revision for you as well. If you know how to do it in Excel, that's really nice. Okay, we have periods, years, and we have cash flows. Okay, we start from year 1. And we said that in year first, if we invest 1 billion, then you generate 200, 300, and 400, 500 respectively. Let me make it bigger. So this is, and we say that there's a rate which is 5%. Discount rate or required rate of return is 5%. So we are asked to calculate NPV. By the way, whatever I solve in the class as an Excel, I will upload it into Moodle as well. You will see it. So we have here the formulation. There's many ways you can calculate it. You can separately, individually discount it each cash flow, add them up and subtract the investment cost. This is our investment cost. This is our investment cost. Okay. So you can, and these are the cash flows that we receive it. So you can separately like take the discount, this divided by 1 plus 5%. It's discounted, but we should fix this 5%. Do you know how to fix it? 5% in Excel? It's Shift and F3. Sorry, Shift and F3. Just press F4. If you press F4 in here, it will fix this in order not to be moved. So you can calculate separately. And we're taken to the power of 1. And when we proceed with this, okay, it's raised to the power 2. You shift this 5 and it moves down. So what are you doing here? You just sum it up and subtract this. This is discounted cash flows. Discounted cash flows. And if you want to calculate the NPV, what you need to do is just sum this all and minus the investment cost. This is your NPV. Or we can calculate using just formulation. We just type in NPV, double click on it. First of all, we should put the rate. We select the rate, B7. We put the comma. Then we need to put the values. We select all the values. We do not select the cost, okay? We just select all the cash flows. And we should subtract from this. By the way, in here, the NPV, it just take into consideration the discounting methodology only. It do not directly subtract the investment cost. So in here, you should do some manipulation, like manually subtract the investment cost minus investment cost. Oops, it gave me the percentage. So this is our NPV, which is calculated in 2 different ways. Okay. Do you have any questions? Do you want me to repeat it again?
Yes, please.
Yes.
Okay.
Yes, please.
And I will do it very slowly. So I'm copying this to another sheet. We have cash flows. Now, our interest rate is 5%. First of all, I want to try by manually calculating the discounting, by manually discount the cash flows. So what I do here, 200 divided by 1 plus R, or 1 plus rate, 5%. So in here, in order to, I want to show you something. This is B7, it stands for 5%. And we're raising to the power of 1, because 1 year left to the year 0 from this point. If you drag it down, you will see that B7 now is B8. Then if you move here, it's B9. It goes and goes. So in order to fix it, you have to give the order in here, in the first cell, which is B7 should be fixed and should not move. It is just pressing by F4. Put the mouse in here and press just F4 and take into the signs of the dollar. That will fix your B7. So your B7 is fixed. Now you can drag it down. So B3, which is 200, 1 plus rate, and to the power 1. Why 1? Because from year 1 to the year 0, there is only 1 year. That's why we are raising to the power 1. I selected A3, but I do not fix it because I wanted to move it correspondingly. If I select the cash flow from the year 3, it should select the power of year 3. If I select cash flow from year 5, it should select the power from year 4, sorry. I just drag it down, and then what you do here to calculate the NPV, we just add them all, sum it up. You can use the equation as sum, or you just manually add them all. Close the bracket, minus investment cost. This is our NPV. And how to calculate using the formula in here, NPV, using the function, NPV function. Just press on it. First, you should put the rate, 5%. You press here 5%. Then you select the values, only the cash flows. The cost should not be included. Select it and close the bracket. It will calculate only the discounted summation of the discounted cash flow. So you need to here manually subtract the investment cost. Gain percentage. So this is our NPV. Okay. So this is if you calculate by calculator, by financial calculator or by scientific calculator, this is how it should be done. Like minus 1,000, 200 discounted to the year 1, 300 discounted to the year 2, and so on. As you can see, if you do it by calculation by hand, maybe it may take up to 5 minutes, but in Excel, it should not take more than 30 seconds if you know how to use the formulation. So the Excel will help you to be more efficient and quick in your answer. Okay, if you don't have any questions, I will move to second investment criteria, which is IRR. Dear friends, if you have any questions, please feel free to ask, because I want you to understand everything, because when we go to the cash flow projections, the life there will be a little bit complicated. That's why I want you to know everything perfectly before we start the cash flow projections. Okay. Feel free to ask.
Sorry.
Yes.
Could you send this Excel on Moodle?
Yes, I'm gonna put it in Moodle, don't worry. Whatever I do in the class, it will be as a video recorded. It will be uploaded into Moodle, plus the Excel file that we have used, it will be uploaded as well in the Moodle. So where it's gonna be uploaded here. Just want to share it, show you. If you go to the last part, for example, these ones are not, don't go for this, okay, guys? I will delete it. I will delete it. Don't go for it. What I advise you, in order to find the file, you have to go check it this site, like tutorial site. I will put all the files here, all the Excel files, like lecture by lecture.
Okay.
So IRR is the rate of return on a project. It is internal rate of return that makes the NPV equal to 0. So it is the rate where the NPV becomes 0. That simply to say, you are at a break-even point. Your cost is equal to benefits. So whatever you spent is you generated enough money just to cover it. This is 0 point. So if IRR is greater than the required rate of return, look, in previous case, our required rate of return is 5%. And NPV in this equal to $219, if you remember, with the 5% of rate of return, required rate of return. Now, what is the relationship between the rates and the NPV? Inverse or positive relationship? If you increase this 5%, go back here. If you increase this one, the denominator, to 10%, what will happen to the number in here? It will increase or go down?
Decrease.
Go down.
Decrease.
It will go down. There is an inverse relationship. Let's try it in Excel. This thing you should keep in mind. The relationship between the rate, required rate of return, and the NPV is inverse. Increasing the rate, NPV falls. Look here. What will happen to your NPV if we know that the relationship between the rate and the NPV is negative? If you increase this to 15, what will happen to your NPV?
Decrease.
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 Let's see it. You see what happened? It became negative. So this is, keep it in mind when we compare the IRR with rate of return. Here. It says that IRR is greater than rate of return. Then your decision is accept project. So what happens? What IRR makes? IRR makes your NPV to equal to 0. So what should be in here IRR to make your NPV 0? Higher or lower?
Higher.
Higher. Higher. But if you put 15%, you have negative, isn't it? You have
Yes.
you're negative NPV. So in order to make
Try
your
with 10.
NPV, so between 5 and 15, your IRR is between 5 and 15 for this project.
15.
It should be between, we don't know.
Let's try with 10. 10.
Oh.
If we try 10, let's try it. Very close. Very close. Let's try it with 12. Very, very close. Let's make
12
it
and
13.
5. 12 and 5. 12 and 5.
4.
Oops, sorry. 12 and a half. Still not enough. Maybe 12 and 65. So we should try it. So what do you think? How long it's gonna take to you to get the IRR? So
Long time.
Long.
it's a very long error and try. So
You might calculate with formula.
Yeah, we need to use the function here, IRR function or financial calculator to get the IRR. So you're welcome. If you want to calculate your IRR by error and try, you're welcome as well. Maybe it will end up with. So we just put IRR. We take all the values, close the bracket. And of course, yes, the problem I know why, because this investment cost should be recognized as a negative number. Otherwise, the IRR will not be calculated. Okay. And of course, in here, we should do the manipulation. let me do the manipulation again. So if it is negative because we are spending it, in NPV, we should not add it. We should not subtract it. You know, minus minus gives you what?
Plus.
Plus. So it automatically adds. So in Excel, it does not follow any logic. I mean, it just recognizes the signs. So we should put a plus here. Plus minus will be
Minus.
Minus.
minus. So this is how it should work. It's 5% here. Okay. Same thing in here. We should add it. Basically, we are not adding the investment cost. We're just showing the function of the addition, but it's in real, it subtracts. Plus minus, it gives in order to calculate the IRR. So our IRR is equal to wow. So in order to get the IRR by error and try, maybe you would need 1 day. Anyway, so if you put this number into the NPV, your NPV will be equal to 0. Let's try it, whether it works in real. NPV with IRR. So I do the NPV. I just press on it, rate. I'm gonna put this rate. I select all the values, close the bracket, and subtract the investment cost. I put plus sign here with the purpose to do the subtraction. Otherwise, it will not subtract. Minus minus, it will give you the addition here. So our NPV is equal to, it shows the percentage, so it should be dollars. 0. So if you want to do manually, if you want to do the manual as well with this rate, so instead of using this rate, use this rate, fix it, you see it? Automatically changed to 0. Okay.
Sorry,
Let's-
can you show a form of IRR and NPV's IRR again?
Of course, of course. I will show it. I will repeat it many times, guys, till you get used to it. So let me do it in here. So everybody is okay with calculation of NPV, yes?
Yes.
Is there any problem?
Yes.
Everybody can do it. Just select. So we put this negative sign in here. Investment cost should be negative. And if we do it, we should put plus sign here. Plus sign here. Now we can calculate IRR. So it's just IRR, open bracket, select all the values with cost. And close the bracket and press enter. NPV with IRR. So before proceeding NPV with IRR and before calculating the NPV itself, it is said in the theory that if IRR is greater than the required rate of return, then capital project adds value, which means the project generates money. The project generates benefits. So there's a positive sign. So you can go and invest in this project. You can proceed with this project. This is what it means. So in here, you can compare. Your IRR is 12.82%, almost 13, and rate of return is 5%. So it's greater than this rate of return. So your project is acceptable. So you can proceed with this project. And calculation of NPV with IRR is simple. We select the rate. In the rate, we select the IRR itself instead of the required rate of return. Then we select the values. So the values only. We do not, in NPV, we do not select the cost. The cost should be subtracted. Minus, sorry, plus, this is my NPV with IRR. Rate, the range of the values, range of the cash inflows of the project, minus subtraction of investment cost. Okay, if IRR is less than required rate of return, so you do not invest in this project. Capital project destroys the value. So we are given here, same project. Actually, you can calculate manually by error and try, or you can use the financial calculator to calculate the IRR, and it's the best to get the NPV, sorry, the Excel spreadsheet to use for calculation, the IRR. So in this case, we do invest our project. We do invest in our project. Payback period. The payback period is the length of the time that it takes to recover the initial cash outflow or the investment cost that you incur when you start your project. How long it takes in terms of time to cover your cost from the future incremental cash flows. So we're given project cash flows in here that occurs in last year and the year 4. Here you can see cash flow 1 million, 1,000, 1 billion, 1 billion. And so this is the way of calculation on the right hand side. Okay, so what do you do first? Subtract from 1,000 to 200. How much will be left after 1 year? 800. Then from 800 subtract 300. How much will be left? 500 after the second year. After the third year, from 500 you should subtract 400. When you subtract it, how much will be left? 100. So in the fourth year you're receiving $500, but you are left only 100 to cover. You don't need to get the whole amount. You need just 100 out of 500. So fully you used 3 years. The full amount of the cash flows are used only from the 3 years, but the cash flow from the fourth year have been used partially. So you use the fraction of the cash flow only from the year 4. So the year 4 will not be considered fully. So how it's been calculated then? As you have used 3 years fully, plus you are left to cover only $100. That $100 will be covered out of $500. So that will give you, this calculation will give you how long it will take to cover your investment cost that you have incurred while running this project in the year 0. Is that clear? Okay. We will get into more examples and you will understand better. So we have here 2 projects. Let's get this project to what we call to the Excel spreadsheet. This is NPV. Okay. This is payback. So project X and project Y. We have 5 years, if I'm not mistaken, or 4 years, 2050, 2050, 45, 60, 2050, 45, 60, and minus 100, minus 100. Twenty, 50, 45, 0. 20, 50, 45, 0. So these are for 2 projects. Let me make it bigger. Project X and Y. So how we calculate it? So the same thing processing here. So after subtraction, after 1 year passed, how long it takes to recover it? Like 100 minus 20, you're left with 80. Okay, I will put it this all red to show that 80. Then from 80, you subtract 50. The second fully year, the cash flow of the second year fully used, 50. So you're left with 30. So in the third year, will you need the whole amount of the third year or just part of it?
No.
Part of it.
So that means you need just $30 out of 45. This is how much you need it. So what you will do, that shows that you have used fully 2 years in the first project and you're taking part of the cash flow from the third year. So 2 plus 30 divided by 45. Let me put it here. One more time. 2 years, because we have used fully 2 years. I mean the fully used, I mean the cash flows of those 2 years fully have been used, plus $30, the remaining amount that should be recovered, but this $30 will be taken from this 45. Then when we go to project Y, same thing in project Y, like 80, it will be all in red, 80, 30, and the same, 30 out of 45. So we'll have the same answer actually for both. We'll have the same answer for both. So in both projects, X and Y, it says it will take 2.6 years to recover our investment cost. Okay, it's discounted something else. Now, which project would you select? According to the payback rule, you would select only 2 of them. So there is no way to select 1 of them. So you will select 2 of them. 2 of them are good because they both give you the investment cost. According to the payback rule, we select 2 of them. But according to NPV, it's different. So there is a problem with the payback rule. We're going to talk about it, okay? The problem is that the payback rule, it ignores future cash flows. By ignoring, for example, in project X, it doesn't take into consideration the cash flow of year 4. But in project Y, the cash flow is 0. So you would definitely have selected project X because it gives you more money. However, the payback rule says, wait, we select the project according to how long it takes to recover the cost. For other criteria, we don't care. So whatever the criteria is, we are just want to know how long it will take in terms of the years to recover our invested cost. This is what is the matter for us. So this is the big problem of payback rule. Another payback rule is the problem is facing is the cash flows are not discounted. Cash flows are not discounted. So, but if the cash flows are not discounted, there's another criteria comes, which is discounted payback period, which says, okay, if it's not discounted, then let's discount it. What will happen? So discounted payback period is the length of the time it takes for the cumulative discounted cash flows that equal the initial outlay. In other words, it is the length of the time for the NPV project to reach NPV equal to 0, just to cover our cost. So here, consider the example of project X and Y that we had it before. We discount them with a 5%, okay? We discount each cash flow here. And the same process, the same way. Okay, let's do it in Excel. That's will make us better. Okay, now cash discounted cash flows X discounted cash flow of Y. So we just discount all the cash flows. By 105, and we're raising to the power 1. Did we discount correctly? Let me just check. Yes. And here, by the way, when I put the numbers in here, like if I didn't put the 5% here, but I directly just type the 5 here, you don't have to fix anything. You just type it and that's it. It does not fix, it does fixing by itself. So the 5 will be in each cell is 5. And here for this, 5 raising to the power 1. So we did the discounting issue. Now let's see how it works with a payback. So same thing here. This, we get the difference between this number. So minus 80, okay? Then from minus 80, we subtract this 45. Then from 35, we get this. Are we gonna use the whole amount? No, we're not gonna use the whole amount. We are just using just part of it. So we need just 35 divided by this 38 out of 38. So that will give us 22 plus 35 divided by this amount. If I put the minus sign here so that it works, minus minus. Why did I put the minus in here, guys? G5?
Because there is minus already.
In order to solve the problem with the signs, so that it does calculation correctly. Okay. With a discount, we can see with the discount payback period, it increased the period of recovering. It increased the period of recovering. So the same thing for the discount cash flow will be project Y. So it should be the same. 2.91 years. So for project Y, it is the calculation exactly the same because the numbers are the same. Okay. This is discounted projects. They discounted and they found, okay. Let me just recheck it, double recheck. Where did I get? Okay, until here is okay, it's 35. And 3 is, okay. That's fine. So which is added here and this is added here. Okay, is there, the last part, what they do here, guys, they are just making addition, but we don't need to make it this additional, adding them up, because we're just trying to calculate how long it takes to cover it. Okay, they're just, this 3.27 is the difference between 35 and 38. And this is added to this 49. And that's why they get it in this way, okay? So the biggest issue related to payback period is that payback period, it has a pitfall, and that disadvantage is they do the payback period, even if it's discounted payback period, it does not take into consideration the future cash flows like 60. As you can see, it is the highest cash flow among the all years that you had in your project, and you're ignoring it. It's not really good. Okay, we're coming to another investment criteria, which is average accounting return. It is the ratio that is taking basically average net income from the project over average book value of the asset. In here, you're just trying to compare with, you're trying to compare with target average accounting return. So you put some target, let's say, I want my average accounting return to be 30%. And when you calculate the net income over the book value, and if it comes like more than what you have put as a target, then you accept the project. If it's less than your target, then you don't accept the project. So if your target is 30% and average accounting return calculated to be 25%, which is less, then you reject the project. And the last one is profitability index, is the ratio of the present value. With the example of the average accounting return, we'll have some example. We'll come to that when we're gonna get into the tutorial part. Okay, don't worry about it. We'll resolve it. But profitability index is the ratio of the present value of the future cash flows divided by investment cost. In order to accept the that specific project, your PI should be more than 1. If your PI is less than 0, you do not invest in a certain project. But if you compare 2 different projects, then you select the highest PI. So the higher the PI, the better the project is actually. We are given saying, let's just employ it, profitability index in here. PI. I'm going to use the same. Now, if we want to calculate the profitability index, PI, what we do here is NPV, open the bracket, select the rate, put the comma, select the range of the cash flows, close the bracket, and divide by investment cost. But we have negative sign, the index cannot be negative. So we need to fix that negative issue, negative sign issue. We put the negative sign in here and divide it by this investment cost. So our PI would be, like in absolute term, it will be a positive number. So in here, the NPV, it doesn't calculate the NPV, it just calculate the present value of all future cash flows divided by investment cost. But in previous slides, in previous worksheet, we subtracted our investment cost in order to get the net present value. So our profitability index is equal to 1.21. So we should proceed with PI, profitability index. One more time. We type the function of NPV, we select the rate of 5%, then we select the range of the cash inflows. We close the bracket and we divide by investment cost. But the investment cost should be a positive number because index cannot be negative number. Okay. Guys, I want to stop here today. If you have any questions, please feel free to ask because I want you now to digest all the information that you have got today. And next time when we meet, we will proceed with the calculation and so on. Do you have any questions? If you don't have any questions, thank you so much. You can leave the conference.
Sorry, so on Friday, will we have a tutorial class?
On Friday?
Yes. You said like bonus points or what?
No, not Friday, not Friday. By mistake, I said Friday because with classes we have Monday and Wednesday. Tutorials will be on Monday and Wednesdays. And of course, we're gonna have tutorials.
For this, will be bonus points?
Which bonuses?
Okay.
You might be confused with some other lectures.
Yes.
That happens.
Sorry.
You got me confused as well.
Yes, I was confused. Sorry.
Okay, you're welcome. You're welcome. Thank you so much.
Thank you for your lecture.
Thank you. Bye.
Thank you. Bye.
Bye.
Professor,
Oh, goodbye.
Yes, please.
I have a question regardless the operations. Like if we have exam and we need to calculate something using Excel, how do we just show the work we did? We just copy paste or what?
No. What you will do, you don't have to make any copy paste. If you're asked to submit your Excel spreadsheet, you will upload your Excel spreadsheet to the Moodle.
Okay.
Okay? If you're asked to do it. If not, there's no need to do it. You just give me the answer. If it's multiple choices.
Okay, I see.
Okay, if any questions?
Professor,
Yes?
can you explain again sunk cost and cannibalization? I didn't get it.
Surely, sure. Sunk cost is the cost which is incurred by certain investor, by any investor actually. And that cannot be recovered. The cost that you incur and that cannot be recovered. And for example, you run a certain project. You purchased land, okay? You invested that money in the land. You spend it. You spend for cultivation, for preparing that land. That's it. And you don't expect to return that money. You spend that money. You spend on advertisement.
Okay.
It's not recoverable. When it comes to the cannibalization, it is the market loss. It's a loss of in a certain project that happens, let's say loss in the sales, which is caused by a company's introduction of a new services or of a new product, okay? When you introduce a new product into the company, let's say you want to do new business, any money you spend on the introduction of it, on penetration, it is called as a cannibalization. Cannibalization is a loss in sales, okay? That cannot be recovered as well.
Okay, thank you, Professor.
You're welcome. You're welcome. Okay. I think no more questions.
Yeah, no questions. Thank you. Bye.
Okay, bye. See you.